Well, good morning, and thank you for joining our webinar today. I don't think there is a more exciting financial statement than the balance sheet, and said no one. But in reality, this is the most important financial statement that you have. If your balance sheet is not accurate and in line, then there is no question that your profit and loss statement is inaccurate, and you're not actually seeing the true net profit being reflected. So today we're going to be discussing the balance sheet and making sure that you understand the importance of this for loan applications, for business valuations, etc. So while this might be a little boring, it's certainly going to be very meaningful for you and very impactful on what the value of reviewing this statement regularly means. So my name is Sydney Lynn, and I am joined today with Brian McCaig. Brian and I are both client advisors at RSI. You'll find our contact information up on the screen. Feel free to reach out to us at any time if you have any questions on this or any other information. And you'll also have our contact information at the end of this webinar as well. Now, the purpose of our call today is we're going to simply go over some basics on the balance sheet, some specific line items that can easily get out of balance that you wanted to make sure that you're aware of and paying attention to. We also want to make sure that we help you with identifying common mistakes. We see a lot of mistakes happen on the balance sheet, and this could lead to adjustments being made at year end and more time-consuming tasks. We also want to look at how to manage due to, due from accounts, if those are applicable to your business. What we also are going to be reviewing is how this financial statement also impacts not only your profit and loss, but also your cash flow statement. And finally, we're going to be discussing best practices on completing a period end review and how to make appropriate adjustments following that. So with that, I think it's a perfect time for our first poll question. Brian, what do you got for us today?
Let's do it. It's going to be a fun one. I also want to mention that, as always, we have a Q&A section of the webinar. So we'd encourage you to get your live questions in that way. We're going to try to get this just under half an hour and hopefully save some time for those live questions towards the end. So get those questions in. If we aren't able to get to them live, on the presentation today, we will be answering you directly. So again, we encourage you to get those in. But let's get on to our poll question for the day, and it's: how often do you look at your balance sheet? You may say, balance sheet, am I supposed to know what this is? And if so, don't worry, you came to the right place. You may say, end of the year, my CPA looks at this. You may say, I look at it quarterly, and maybe that's for investors. You may be one who looks at it every single period, and you may be one of those teachers' pets who look at it every single week. I'm going to put this poll question up on the screen for everybody to get their answer in, and it should be up on your screen now. So again, balance sheet, am I supposed to know what this is? End of year, my CPA looks at it. Quarterly for investors, every period, or every week. Sid, a lot of answers are coming in, and it is across the board. I'm going to give everybody some more time to get in because I still see a lot of answers coming in. I love those of you who are being honest right now about.
Yeah, that's why they're here. I'm so glad
that's why you're here. Am I supposed to know what this is?
Exactly.
All right. Looks like it has slowed down, so I'm going to share those results. So a lot of people, and this is not surprising me. A lot of people end of the year, and maybe their CPA needs some help and needs some adjustments. Sid, we're going to try to save everybody a lot of money by having to pay your CPA extra to do potentially cleanup at the end of the year. If you're able to keep track of your balance sheet and keep an accurate balance sheet throughout the year, that's going to be less money you have to pay your CPA to clean it up at the end of the year.
Yeah, I mean, you'll be able to file taxes much more quickly and maybe not even have to file extensions. So hopefully what we go over today will be a help to you.
No doubt. Okay. Let's get on to the basics, and starting with what a balance sheet is. So a company's balance sheet is actually comprised of assets, liabilities, and equities. And the reason it's called a balance sheet is because the assets must equal the liabilities plus the equity. So let's jump into assets specifically. And these represent things of value that a company owns and has in its possession. There's something that will be received and can be measured objectively. I want to show you some examples for restaurants specifically. starting with the good old house bank. So every restaurant that I've worked in calls this something different. It might be your safe. It might be your petty cash. It might be your petty. It might be just called a bank or a house bank or drawers. But unless you're at a cashless restaurant, you have some version of this. And it represents the amount of cash you have in your restaurant, not including your cash collected for that day's deposits. You need to have daily or shiftly counts of this to ensure accountability, prevent fraud, and you'll see a little bit later in this presentation, potentially prevent inaccurate accounting and inaccurate P&Ls as well. Another good example of an asset for a restaurant are capitalized expenses. So if you have a large expense, like a new piece of kitchen equipment for $5,000, your CPA might suggest you treat this as a capitalized cost and record it as a long-term asset on your balance sheet. What does this mean? This means that the $5,000 you spent doesn't hit your P&L statement as an expense right away. It hits your balance sheet as a capitalized asset, and then you or your CPA can set up a depreciation schedule to incur the expense spread over future periods. Another good example of an asset for a restaurant are accounts receivable. So a lot of people are familiar with this term. These are amounts that are due to your business but not yet paid for by the customer. And along with that, house accounts are really similar to this. They're a lot like accounts receivable. I actually like to think of house accounts as Norm at Cheers. Remember Norm? He didn't pay his daily bar tab until a later date, but the bar needs to be keeping track of that amount through a house account. I can only imagine what Cheers' balance sheet looked like. I'd have to do a lot of cleanup there. Either of these, house accounts or accounts receivables, should only be used if you're going to be paid back for those in the future. All right, next part of the balance sheet is liabilities, right, Sid?
Yeah, and first and foremost, liability is something a person or company owes, usually a sum of money. So let's start with going over some specific liabilities you might find on your balance sheet. One big one that we see often are prepaids and accruals. So depending on if you are accounting on a cash basis or an accrual basis, you may have some prepaids and accruals set up. So something that you need to evaluate when you are considering setting up an accrual is that managing these can be very time consuming and can also lead to more work on cleaning up your balance sheet at year end or quarterly when you are doing your review. Also, when adjustments are made and the accounts are trued up, this could potentially lead to a negative impact on your net profit. So our recommendation always is, instead of these options of setting up prepaids and accruals, you may want to consider utilizing a budget by expensing these as they're being paid while seeing the true impact to profit less the expense in that projected budget. And that way you're not having to manage these prepaids and accruals on a frequent basis to get them trued up. Another thing to consider with prepaids and accruals too is that automatically the expense is hitting your P&L, but then it's easy to miss a payment if you're not paying attention to the balance sheet. So you might actually miss a payment to one of those vendors if you are closely looking at those. So keep an eye on those. Another area that we want to talk about is gift cards. So remember, at the time that you sell a gift card, this is actually not a sale. This actually relives on your balance sheet as something that is a liability that is owed at a future date. When the people come back to redeem those gift cards is when that liability will decrease on your balance sheet. So you've got to make sure that the total amount that's sitting on your balance sheet really is reflective of how much is left out there waiting to be redeemed. Sometimes what happens is that for clients that might be using paper gift cards instead of an electronic gift card, they're just handing out a paper gift card with no funding, no cash backing the value of that. And if you're giving it away for a dissatisfied guest or something like that, then it really is considered a comp that would hit your expense lines instead of living as a gift card balance on your balance sheet. So something for you guys to make sure that you're always paying attention to. Another area would be credit card tips payable. So for those of you that are paying credit card tips on payroll checks, this can easily get out of balance if you aren't verifying the total amount that was collected is matching to the penny of what was paid out on payroll. Remember, this is not your money. The total amount of credit card tips that are collected to the penny need to be paid out to the employees. So there should never really be a balance left on your balance sheet when it comes to credit card tips payable. If you do see a balance reflected, if it's a credit balance, then you actually are holding on to their tips that need to be paid out to the employees. If it's a negative balance, then that means that you've actually paid out more in tips than what was ever collected, and this is just cash leaving your bank account then. So always a good practice to make sure that you're staying on top of that every payroll period. Another big one will be your credit cards. A lot of people are using American Express or Visa, MasterCard for purchases for some of the things that you're purchasing. When you're looking at your credit card balances on your balance sheet, this should match up to your statement of what is reflected owed. If this balance isn't matching, then you might have expenses that haven't been recorded, or you might be recording payments with no expenses to be reflected. So it's very important that you make sure that you are staying on top of all of your credit card purchases, that those are all being accounted for. And most importantly, if you're carrying over a balance month over month on your credit cards, you've got to make sure that you're also recording that interest expense. Another line item I want you guys to be aware of will be unclaimed property. When you have employees that do not cash their payroll checks, this is still their money. So even though those payroll checks stale date out and that money still remains in your account, this is still owed to the employee anytime they come back to request it. So anytime you have stale dated payroll checks, they live on your balance sheet as a liability of unclaimed property up until the date that the employee reaches out to you and says, hey, I'm missing this paycheck. You need to cut me a check now. And just remember, you're just going to cut an AP check for the amount that's owed to the employee and code it to that unclaimed property balance. Now, this might be some basics on assets and liabilities, but that isn't all that can get out of line on the balance sheet. Correct, Brian?
No doubt. Let's talk a little bit about long-term debt and owner's equity. When I'm talking long-term debt, most commonly, this is probably a note payable, which is another word for a loan or a debt. But these loans are represented on the balance sheet as a liability because you owe this money. In addition, in this section of the balance sheet is your owner and investor activity. This is where owner investments or draws are recorded. The best practice is to really separate this out by the owner or investor's name so that it lives there on the balance sheet and is easy to recognize at the end of the year. Let's dive into those common mistakes we were talking about. And I want to start with the most basic common mistake. There's a reason we had this poll question at the beginning of the presentation. And it's because most people, and a lot of people on this call, do not look at the balance sheet frequently enough. And really, first things first, in my experience, the balance sheet is overlooked all the time. It's not just the people who are honest on this call, but a ton of restaurant operators I've worked with. And a lot of those same restaurant operators are really diligent and disciplined about checking their P&L on a regular basis. But they tend to ignore that balance sheet, like we said, until the CPA needs to file their taxes at the end of the year. And the big mistake here is assuming that the balance sheet has nothing to do with that P&L, that you are diligently reviewing and making crucial operational decisions based on. So please hear me loud and clear. An inaccurate balance sheet can often mean an inaccurate P&L. Next common mistake, we started to talk to a little bit earlier in the presentation, but not recording all your transactions. And right off the bat, you may say, hold on, Brian, we're on the balance sheet, not the P&L. Of course I'm recording all my transactions. I'm getting all my expenses in. And what I see often is you may be performing a bank reconciliation on your main operating account. So you're ensuring that all those transactions are being accounted for. But what about those credit card transactions that Sydney talked about a little bit ago? or the cash that you used to pay for that delivery the other day. Credit card balances should be accounted for as a liability on your balance sheet, and the balance should be checked for accuracy on a frequent basis. Again, if that balance is misrepresented, you may have expenses that should have occurred on your P&L already. Same thing if you pay for something in cash. Cash, honestly, is not an ideal practice, paying for things in cash, and it should be avoided unless absolutely necessary. I'm sure everybody can imagine, because there's a lack of receipts and a lack of accounting and an easy opportunity to misaccount for things that are paid for with cash.
You know, Brian, I work with a lot of owners, and sometimes I see a lot where they're using their own personal funds as well, not business funds, not coming out of the main operating, but they're like, oh, I need to get this on the fly. I'll just go ahead and write my own check for it and use my personal money with it. So those, transactions are also getting missed if you're not making sure they're getting properly recorded on the balance sheet.
And that goes along with exactly what we're saying. I'm glad you brought that up, because really the thing to take home is everything, no matter how it's paid for, needs to be recorded one way or another. It's easy for things that are paid for separate from your operating account to get missed. So make sure those balances are living on your balance sheet and you're checking them regularly. All right, let's get on to our next common mistake. And this is back to loan payments. So recording those loan payments without expensing out the interest. Don't pay your CPA at the end of the year to clean this up. Every time you make a loan payment, separate out that interest in the capital. The capital portion should be reducing your liability, and the interest should be an expense on your P&L. All right, another common mistake. Sid talked about it a little bit, but this is worth talking about and diving a little deeper into, and it's got to do with gift cards. And we're bringing this up because we see this all the time. The gift certificate or gift card liability not being recorded properly. So to properly forecast your cash flow, I really want you to know how much outstanding gift card liability you have. A lot of times I start working with restaurants and they have these practices where they're really generous with gift cards. And maybe it's to build future sales, donations, guest recovery, trading. I think this can be a great tool to build your business and spread goodwill and be a part of your community. I'm never going to try to talk you out of this. However, I want this to be accounted for accurately on your balance sheet. You may have a gift card program through your point of sale which automatically tracks this for you. But if you don't have that kind of system, it's on you to record the sale and the expense with any gift card you give away. Sid, you have some experience with paper gift cards, right?
Yeah, and we see that a lot. I mentioned it earlier. If you are using paper gift cards, you have to treat those as gift card comps if you're just giving them away. If there's no money backing it, then it's really a comp. So if with those gift cards come back to get redeemed, instead of closing it out to your gift card tender, you want to make sure that you are comping that total amount, not tendering it.
And again, back to what Sydney said earlier, this is crucial in forecasting your cash flow as well, because you get all the cash for gift certificates at the point of sale, but you don't want to be caught surprised when everybody's redeeming those gift cards in a lot of times January or February, which can be cash poor months for restaurants as well. We covered this pretty extensively in our cash flow webinar, which you should have a link to in training and education in RSI if you're interested. But don't get caught by surprise like this. Having an accurate gift card liability on your balance sheet is crucial.
Now, some of you may or may not have the need for setting up due to, due from accounts. So typically, these are needed when you have one or more locations or possibly a holding company, a management company, etc. So they're used to track money owed to or from a company. This could also be considered an intercompany receivable. So first, do you need to set up a due to, due from? The only time when this is needed is when you are needed to make sure that you are trying to move an expense from one entity to another. It is important to make sure that you are recording these transfers of expense on both ends, and that's really typically what we see get missed on the managing these to from accounts. The credit to the company it is coming out of needs to be recorded, and the debt, the expense to the company it is going into needs to be recorded. So both sides have to be captured. Now, while these could get out of balance, if you are an RSI client of ours, then know that you have the ability to record all of these inventory receivable transfers through our inventory transfer option, and it will auto code both ends of this to keep your due froms in line. You could easily determine if your accounts are out of line by looking at your balance sheet. You'll see on the screen, and what we're showing you is that the credit and the debit matches to the penny on both of the in and outs for both of those companies. These always have to match up to the penny. If they're not, then that's going to be causing extra work for the CPA at year end to identify what was missed and how to get these in balance with each other. These can get to be a pain in the butt, so make sure that you're recording these accurately so that way it creates less confusion at your end. These also have bearing on the cash flow statement too, correct, Brian?
Yeah, no doubt. Okay, so let's talk a little bit about cash flow statement, and specifically how does the balance sheet affect that cash flow statement? So remember, your cash flow statement represents how your balance sheet and P&L work together to have an impact on your cash and operating accounts. This is a great way to understand where your money is going. The cash flow statement is the answer to that question, why does my bank account balance not reflect my profit? The more you understand this statement, the better you can forecast your cash flow. And the more you can be strategic and plan out your cash flow activity, kind of like we were talking about with the gift certificates. Questions like, when am I going to need to dip into my debt? Or is my existing line of credit and the PPP loan I got enough to get me through the rest of the year? Or when is it smart time to buy that reach-in cooler? If you are going to trust the information on your cash flow statement, I'm going to go back to accuracy again. And in order to ensure your balance sheet accuracy, the best activity you can perform is a period end review.
Yeah, absolutely. And of course, I'm not going to complain if you're looking at the balance sheet on a weekly basis, but I definitely hope that you are looking at it at the end of every period. So doing a thorough period end review is essential for keeping all of your financial statements in line and accurate. Now, when you do a period end review, the three most important financial statements that you're going to review at the end of every period for identifying inaccuracies, potential areas of opportunity, understanding, what has impacted either that profit or cost, etc. This is going to be your profit and loss statement, your balance sheet, and your cash flow. These are the three statements that every owner-operator and managers for that as well on a period basis. So what we recommend is that after your bank reconciliation has been completed, you review all three of these financial statements at length. I always recommend that maybe you run your general ledger register for that period of time so you can quickly see all the activity that occurred under each of your GLs. This will populate for both your balance sheet GLs and your profit and loss GLs. This will help you look at vendors. Maybe you see a vendor that's miscoded to the wrong thing, or maybe a dollar amount. So it's a quick way for you to dive through and look at the activity. When reviewing your balance sheet, you actually have the ability to click on those values as well and drill down, and it'll give you a trial balance of the activity of the credits and debits that hit that account as well. So you can also review that to make sure there's no journal entries that are needed. Once you've actually reviewed all of these statements, then you're going to be able to review the bank statement and make sure that everything is accurately posted. If there are already adjustments that need to be made, you can quickly make those adjustments at period end and do a final closeout of that. This will ensure that your balance sheet will be accurate and your profit and loss is accurate, so that way you know exactly the impact of your cash flow period over period, as well as what your profitability is. This will be essential for you if you really want to make sure that you're eliminating extra time at year end with having to go back and review it. And remember, if you're doing this every 4 weeks, it's a lot easier to remember what happened every 4 weeks than a year end and you're trying to remember something that happened 12 months ago. I see it all the time. When you go to review balance sheet at year end and you've got a year's worth of activity and you can't remember what happened when, it's going to be much more difficult for you and your CPA to finalize those year-end taxes. So really strongly encourage you to make sure that you are doing this every single period. And going back to what Brian was talking about with the cash flow statement, this is also going to really help you identify where your cash is going period over period. You can quickly identify financing activity via your cash flow statement, and this will actually help you understand what needs to be happening going into the next period to keep your cash flow strong. Now, while these are basics to understanding the balance sheet and, obviously how it impacts the other financial statements, there's obviously much more on your balance sheet that you want to make sure that you're aware of. So it's going to be key for you and your health of your business and your financial success to make sure that you're reviewing these. And if you have questions on them, please don't hesitate to not only reach out to your RSI accountant, but you can also reach out to your client advisor, your ops specialist, etc.
Yeah, we'll have our contact information at the very end of this presentation in just a second here. And you'll also get a follow-up email after this presentation is over with a link, and you could just respond to that email as well. Sydney, we did a good job time-wise because we do have some time to see some of the questions that came in. Thank you so much for all the questions that came in. I see a bunch came in. We aren't going to be able to get to them all. So like I said a little bit earlier, if there's one we aren't able to answer live on the presentation today, we will be reaching out to you directly. Sid, the first one that I see is a really good one. I need help with my balance sheet and I don't know where to start to clean it up. Okay, so a lot of people who haven't been looking at their balance sheet a lot, according to that poll, who now are like, okay, maybe I should start looking at it. How do they go and clean it up?
Great question. So if you are an RSI client, then immediately you want to reach out to your RSI accountant and ask for them to tee up a financial statement review. They'll go through your balance sheet, look at all of the different line items, question out anything that either is out of balance or they have questions on, et cetera, to help assist you on getting all of this cleaned up. But you can also, I encourage you to reach out to your current bookkeeper whoever's helping you with this and have them, go through every line item on the balance sheet and make sure it's accurate. So with loans, you can look at your last vendor loan statement and be able to compare that balance to what's reflected on your balance sheet. For your house bank, petty cash, count the amount of cash you have in your restaurant and compare that to the balance that's sitting on your balance sheet. For your credit cards, look at your last statement. Make sure that matches up to what exactly is showing on the balance sheet. So a lot of your line items you can quickly research, to see exactly what is outstanding. With house accounts, you can run a point of sale report, see exactly how much was tendered and see how much you've actually collected from that person. So many ways for you to do this, but if you are an internal RSI client of ours, please reach out to your RSI accountant and get this scheduled if you have any questions on it.
Perfect. Okay, next one. And this one I want to make sure we get to because it's especially relevant this year. A lot of confusion around this. Should I record my PPP loan on the balance sheet? It's kind of a loan, but I know it's getting forgiven. A lot of confusion about this one too, Sid, right?
Absolutely. The PPP loan is a loan. And yes, it absolutely, hopefully for everybody on this call, will be getting forgiven in its entirety. But it is a loan. So I'm sure all of you have already received the loan. It's already hit your operating account, and hopefully you've already recorded that entire amount to your balance sheet. Now, this isn't to be confused with the EIDL grant, the $10,000 that came in and the loan over and above that. The $10,000 grant for EIDL will actually live as other income on your profit and loss. But for the loan over and above that $10,000, as well as for the PPP loan, those do need to live on your balance sheet. Once the forgiveness portion and process has been completed, then journal entries will be made to offset that and reduce it back down to zero, depending if you got 100% forgiveness. This will happen towards the end of the year after your forgiveness application has occurred. So it will remain on your balance sheet, though, up until that point it's been completed. Great question.
Sydney, I have one more I think we have time to get to, and it came in from somebody anonymous, so I want to make sure we get to it because if you asked it anonymously, we aren't going to be able to respond to you directly with the answer. So this one is, when using personal funds, how do these transactions get recorded? How is one reimbursed for these transactions?
Really great question. So if you are an owner and you went and used personal funds for a purchase, you then determine, do you want to consider that equity or do you want to consider that a loan to the business? So if you do use your personal funds, then let's say you spent $1,000 of your own personal money, but you want to be paid this back. You're just basically paying for it for now because you were low on cash, but you're going to get this money back. Then you're going to want to record that $1,000 as a loan to the business. So you would set up a note payable with your name on your balance sheet for $1,000 and then record the expense on the profit and loss for what that purchase was for. And whenever you decide to pay it back to yourself, then you simply write yourself an AP check to that note payable and reduce that balance back down. Otherwise, you could just treat it as equity and cash infusion into the business and just increase the amount of equity that's living on your balance sheet.
Perfect. Okay, that brings us to an end. And I got to say again, Sid, congratulations. We're just about where we wanted to be time-wise.
Wow, I kept our first webinar at 30 minutes, folks.
All right.
We're trying.
So up on the screen right now is our contact information. I want to thank everybody for joining and attending today's webinar. Like I said, we'll be sending you a follow-up email with a link to this recording. If you're an RSI client, the recording will also be available in education and training resources. We have a lot of fun doing these. Hopefully you're finding some value and education in them. Sid, thanks. Great job.
Thank you so much. Have a great day.